taking the time to come on to this evening's webinar on savings and investing. My name is David Looney. I'm a financial advisor with Alpha Wealth. For those of you who might be on this webinar for the first time, just to note, we have been doing a lot of these kind of online financial webinars over the last 2 years or so, just giving people, I suppose, impartial financial advice across a kind of a wide range of different personal finance areas, and it just kind of allows people to kind of make, I suppose, more informed decisions with their money and their kind of personal finances. If anybody is interested in kind of following what upcoming webinars we have coming up, you can follow us on, you know, the usual social media channels like Instagram and Facebook and LinkedIn, and we'll be announcing the webinars as they go. Today's webinar, as I mentioned, is focused on kind of savings and investing, and it's just really kind of giving people, I suppose, some information on some alternative savings options that are out there in the market. I suppose my experience is that meeting clients, a lot of people are just saving into the kind of bank, credit union and post office, and not only do they not know what other options are out there in the market, they don't really know why they should be looking at other options. So I'm just going to, I suppose, run through that, give you a feel for what else is out there in the market, and I'm just going to mention, I suppose, a more kind of specific tax efficient investment option at the end as well that might be suitable for anyone on the call who's a top rate taxpayer. Okay. So just before we go into things, I just wanted to give people a quick introduction to who Alpha Wealth are. For those of you who might not know, we run an independent financial planning company headquartered in Cork. We have over 3,000 clients throughout Ireland at this stage. We have over 120 million euros of assets under management. We are a fully central bank regulated company, and we have 8 advisors in Alpha Wealth that basically provide independent financial advice to individuals and families and business owners like yourselves, to basically help them in, you know, many different areas of kind of personal financial planning, you know, things like savings and investments, retirement planning and pensions, mortgages, protection insurance, tax planning, and many other areas. So if anybody does want to, you know, touch base with us after the call, who would want to find out a bit more information on our services, look, we're happy to help. If anybody does have some questions throughout the webinar, feel free to pop them into the chat. I'm joined by some of my colleagues today on the call, including Clino Dunhu, who is our business development director. And look, we'll do our best to answer. And look, if there's some time at the end, I'll open it up to a Q&A, and we can always follow up with people after. Okay. So getting right into the throes of the presentation, I think the 2 kind of main challenges for people out there at the moment when it comes to their personal savings, or, you know, any of their savings really, is the risk of low interest rates and rising inflation. Particularly over the last couple of years, you would have noticed that the banks, credit unions and post offices are giving, you know, virtually 0% interest on your savings. And a lot of banks are even starting to apply negative interest rates on savings. So they're basically charging you for kind of the privilege of holding your money. We're starting to see it with some corporate deposit accounts and with some personal accounts over certain thresholds. What's kind of adding to that, I suppose, is inflation, which is really ramping up over the last couple of months. For anyone who doesn't know, inflation is the rate of rise in the price of goods and services year on year. So what's happening at the moment really is that for any amount of money that people have sitting in the bank, credit union or post office, it's sitting idle, it's not growing, and meanwhile the cost of living is increasing year on year, which means that people are losing value or losing purchasing power on their savings, and that becomes quite devastating over long periods of time. So it's important for people to appreciate that cash or deposit is not a solution for long-term savings. It is fine over shorter periods of time, but it has never been a solution for long-term savings, and it never will be a solution for long-term savings in my mind. If you look at the image over here on the top right-hand side, something that maybe most of us can relate to, it's, I suppose, how inflation has influenced the price of a pint over the last couple of decades. You'll see back in 1990, it cost just €1.93 to purchase a pint on average. Fast forward to 2021, last year, the average price of a pint was up at $5.50. So the price of a pint has more than doubled over the last couple of decades. And unfortunately, the price of a pint isn't the only thing going up year in year. You know, house prices are going up, cost of living, energy costs, college costs, education costs. So It is really important to make sure that our money is going into places where it's earning an interest that is at least matched by the rate of inflation, to make sure that our money is keeping pace with inflation and growing. You can see on the bottom of this right of the screen here how kind of interest rates in the Eurozone have kind of flatlined across 0% over the last couple of years. If anyone doesn't believe me how poor the interest rates are in the bank, credit union and post office, you can just see some of the interest rates that are offered by An Post or the state savings today, which would be the best of a bad bunch between bank, credit union and post office. If you look at the 5 years 5-year savings certificate, it's giving just 3% over a 5-year period, which is 0.59% per year, so well below the rate of inflation. And one thing for certain is that anyone saving in the post office over the long term is guaranteed to lose value on their savings. And that's why, you know, I have to reiterate that it's not, I suppose, an appropriate home for long-term savings because of that reason. You'll see some kind of recent news articles over the last couple of months about, you know, inflation really ramping up. Over longer periods of time, average inflation rates are more in the region of about 2 to 3% per year. The central bank would see 2% as kind of, I suppose, a normal inflation rate. However, we have seen inflation rates up around the 5, 6, 7, 8% per year in the last couple of months, mainly driven by kind of energy costs. So you'll see articles here like inflation hit 7% in April, inflation and higher taxes hit real wages in Ireland. And really, I suppose one of the main ways that we can make sure that our money is keeping pace with inflation is to invest it and make sure that it's getting a return, as I said, that at least matches inflation, so we're not losing money. So why you should invest, really, I suppose, as I mentioned, is because leaving money sitting in cash or on deposit is certainly a bad idea over a long period of time. So, for example, if you take Michael here, who has 100,000 sitting in his bank account earning 0%, which is the current interest rate that you would be getting on a bank account, the impact that inflation will have on Michael's money over 15 years can be quite devastating. If you look at a normal inflation rate of 2% per year over 15 years, his €100,000 would reduce in value to more in the region of €73,000. So he's after losing more than 25% of the value over the 15-year period in normalized inflationary, I suppose, a normalized inflationary environment. Look at more extreme rates of inflation that we're experiencing at the moment, you know, 5% per year, you're actually losing more than half of the value of your savings amount over the 15-year period. So for anyone who thinks that saving in a bank, credit union or post office comes at no risk, you know, this just proves the opposite. And the thing that people need to appreciate as well is that if they have money sitting in the bank, such as Michael here, your bank is delighted, because what they're doing with your money is loaning it out and investing it themselves to make themselves interest while you're losing value. The banks are making money out of you. They're not paying you any interest. Meanwhile, they're using your money to generate interest for themselves. So it's about being smart and, you know, getting your money working for you and not your bank. Something I speak to a lot of people about when it comes to, I suppose, savings plans and savings goals is saving for their kids' third level education. We know education costs have gone through the roof, and we know that generally they do increase year on year. And one of the largest insurance companies in the Irish market, Zurich, who I'm going to mention a bit about later on, done a lot of kind of, you know, studies on this. And at the moment, they estimate that the average annualized cost to send a child through third level education, if they're living at home, can be up to €4,894 per year per child. That increases to €9,000 per year per child if somebody has to stay in rented or student accommodation while they're in college. So over the 4 to 5 years of a kind of degree to master's program, you're looking at total costs anywhere from about €20,000 up to €36,000. So what we would be saying is it really is important to kind of plan early on and put a plan in place to meet those costs. What Zurich have also found, unfortunately, is more than 52% of Irish parents go into debt to finance third level education. So there is, I suppose, a tendency to maybe kick the can down the road. And unfortunately, you know, if you are someone who's relying on loans to finance third level education, with those figures mentioned on the screen, you could be looking at loan repayments in the region of €380 per month to €700 per month over a 5-year period. So that can really put people into financial difficulty down the line, and it can be avoided easy enough by planning early on and putting away, a small amount of money on a regular basis going into the right place. So the first thing people need to do, as I said, is to plan early and start saving. I mean, we should all be saving a portion of our regular salary or our regular income if we do have scope to. And you'll see, how much money you can accumulate over a longer period by just putting away a small amount on a regular basis. For people who are saving for things like kids' college costs or kids' education costs, I typically do recommend that they invest the child benefit of €140 per month into an account which is going to earn interest for them. In this example, we're assuming that somebody is going to achieve an interest rate of 3.5% per year, compounding, which is very doable over a long period of time with some of the options that are out there in the market. The other thing to appreciate is that you need to get an account which allows you to benefit from compounding interest. Any of the interest in banks, credit union and post office is simple interest, and there's simply no interest rate there anyway. So for somebody who is saving, say, €140 per month, after 5 years, they could expect a fund value of €9,000, which is kind of, maybe there when the child would start primary school. After 12 years, they could expect a fund value of about 25,000. And after 18 years, which is typically when most kind of kids start looking at third level education, you could accumulate a pot of about €42,000, which would put a fair dent in those education fees or costs and really take some pressure off you. If you're fortunate enough to have, I suppose, a lump sum of money already accumulated sitting on deposit, and you decided to invest 10,000 as well as the €140 per month, you could come out with €19,853 after 5 years, 36,695 after 12 years, or 54,500 after 18 years, which again, puts a fair dent in the education costs. My experience is that if people are saving the child benefit of €140 per month from when the child is born or a very early age, that they generally will have enough to finance their kids' education. The second thing that we need to do is to make sure that our savings are going into the right place, as I said. So investing in savings funds which give exposure to financial markets over the long term has historically paid off. People do need to appreciate that. And there's many reasons for you to invest over the long term, such as saving for retirement, a college education, or for a property. The longer you remain invested, the longer your money has to grow through the power of compound interest, as I mentioned, and the more likely it is to ride out any short-term declines in markets, because we know that markets move upwards over longer periods of time, but in shorter periods, as we are experiencing at the moment, things can be quite volatile. So if you have any kind of long-term savings goals, be that retirement, kids' education, building up a bit of a nest egg for yourself, you should really be investing that money to, take advantage of that fact. If anybody doesn't think, investing is worth it versus just leaving money sitting in cash, I would refer you to this study from Barclays Bank. So at the top line here, you can see that equities have historically consistently delivered a inflation-beaten return versus cash on the bottom line, which over the last kind of 10 to 15 years has consistently produced a negative return after inflation. And you'll see even over the longer term, there has always been the existence of a reward for somebody investing in things like equities, and of course in a very diversified manner versus just leaving their money sit in cash. So last year, we launched something called the Alpha Savings and Investment Club, basically to kind of educate people on some of the different savings alternatives that are out there in the market, and allow them to make more informed decisions when it comes to kind of saving their money and kind of doing it, I suppose as a group, with myself and people in Alpha Wealth and over 2,000 of our clients that are using the plan. So basically our kind of goal under the Alpha Savings and Investment Club is that we want to help you achieve your financial goals and help instill good savings habits that will help your hard-earned money work harder for you, rather than sitting idle in the bank, credit union or post office where interest rates are at an all-time low. The plan we use as part of the Alpha Savings and Investment Club is the plan that we've been using since Alpha Wealth was set up. It's the plan I use myself for my own savings. It's the plan I use for all my clients. It's the plan that my clients use for saving for their kids' education. And it's basically offered through Zurich, which are the largest insurance company in Ireland. They're one of the biggest fund managers in the world. The last time I checked, they have about $3.8 trillion of assets under management worldwide. So a very, very reputable company, bigger than all the Irish banks put together. And I would regard the Zurich Easy Access Savings Plan as the best savings plan in the Irish market. I have no ties to Zurich, or Alpha Wealth has no ties to Zurich. We deal with, pretty much every provider of savings products in the Irish market. So I do, want people to think that anything I do suggest is on the basis of me believing it is the best of its type and most appropriate to people. But what the Zurich Easy Access account allows you to do is to save on a regular monthly basis, fairly accessibly, from €100 per month upwards, and from a lump sum of €5,000 upwards. It's very flexible in that it allows you to increase, decrease, stop, or restart your savings at any stage. It's also open-ended, okay, so you can take out your money at any stage at no penalties. And it basically, like, where it differs to a normal standard savings account in your bank or your credit union, is that it allows you to access some of Zurich's market-leading and award-winning savings funds. Zurich have about 40 different investment funds under their banner that you can access, and all of them will be categorized on this risk scale between 1 and 7. Now, what level of risk and reward you take on is really dependent on your situation and the time frame that you have in mind. Risk and term is generally correlated, okay? So the longer you have with your savings goal, the more risk you should be prepared to take. I think there's a bit of a misconception out there with some people that taking investment risk is just opening them up to their investment being wiped out, whereas it's in reality it's more about how much up or down the value of a fund can go on an annual basis. So the longer you have, you can afford to take a bit more volatility in markets, and markets generally do move upwards over time. As we know, they can be quite volatile over shorter periods. So by giving yourself that kind of long time frame, as I mentioned earlier, it is allowing you to ride out any kind of short-term volatility in markets. Most people who come to us who would be saving for things like, kids' education, or maybe, property in 5-6 years time, or just building up a nest egg, anything really kind of beyond 4 or 5 years, would be kind of looking at moderate risk or medium risk, middle of the road here on the risk scale down on the bottom right hand corner. And what that really means is that the fund will aim to achieve returns in the region of about 5 to 10% per year. But if markets get volatile, it could also lose between 5 and 10% per year. And it is not a kind of flip the coin situation where you either make or lose 5 to 10% per year. We will have a lot more good years than bad years in markets. So the funds of choice as part of the Alpha Savings and Investment Club for most people that have that kind of 5 to 6 year plus time frame, as I mentioned, is a 50-50 split between two of Zurich's kind of most popular moderate risk funds. One fund is called the Prisma 4 fund, that we would typically provide 50% exposure to, and another fund is called a balance fund, which we would provide a remaining 50% exposure to. Both funds are incredibly well diversified and really well managed, and they both have a really good track record. Like the Prisma 4 is one of the best performing medium risk funds in the Irish market. The Balance Fund is one of the oldest funds in the Irish market. It's been around about 33 years now, I believe, and it's delivered annualized average returns of about 10% per year over that 32-year period. So the fund has been through quite a lot and it's been really resilient. You can see down here how the funds have performed over the last 5 years. And I think it's quite funny, I suppose, if we look back 5 years ago, if I was to tell you that over the next couple of years, we would experience a global pandemic, a war, rise in inflation, and 2 fairly significant market corrections, many people would have said, Jesus, no way am I going to invest over that 5-year period. And if that was your opinion, you would have missed out, because these two funds produced returns from 32% to 35% over the last 5 years, even despite all those challenges, which just shows you that long-term investing does win, and it is a much more favorable scenario than leaving money sitting in a bank, credit union, or post office, where you would have experienced 0% returns over that 5-year period. This is just kind of a breakdown of the Balance Fund and the Prisma 4 fund, so you can see how kind of diversified and spread out the assets within the fund are. If you look at some of the top 10 equity holdings in the Balance Fund, you'll see companies like Microsoft, Amazon, Apple, Google, fairly, blue chip household names. Microsoft, which is the largest stock holding within the Balance Fund, actually represents only about 1% of the overall fund. So that just gives you a sense of how spread out the assets within the fund are. what I do kind of, I suppose, ask people to really make sure as well is that if they are already contributing to a plan like this, I know a lot of the banks push them, is that they're getting the very best options that are out there on the market. As I mentioned at the start of the call, Alpha Wealth are an independent provider of financial products. We're not tied to any specific providers. And the benefits of using a company like us is that we can seek out the very best options in the market rather than being bound to certain providers. So you'll just see here how the Zurich Prisma 4 fund has performed over the last 5 years versus some of the other fund managers in the market, such as Irish Life, New Ireland, and Aviva that people will be familiar with. So all of these funds are medium risk funds, risk level 4 funds. The Prisma 4 has returned 32% over the last 5 years versus Irish Life 16%, so about half the returns of it. New Ireland 20%. And Aviva 11%, you know, nearly a third of the returns of Zurich over that 5-year period. So it's about making sure that you are availing of the best options that are out there in the market. And it's also really important to consider what charges you are paying on these funds. I worked in one of the main banks before joining Alpha Wealth about 5 years ago, and they used to sell similar savings plans at 97.5% allocation, which means that they were taking a contribution charge of about 2.5% on every investment amount, and their annual management charge was close to 2%, and there was a monthly policy fee on some of their contracts, and they were locking people into it for a 5-year period. We would see ourselves as an extremely low cost broker. We actually give people 101% allocation on any of their contributions to the Zurich Easy Access Savings Plan. So we actually cover the 1% government levy. So people are getting a 100% net allocation. There's no performance related fees. There's no monthly policy fees. There's no exit penalties. You know, people can access the money at any stage. So we would see it as the best savings alternative in the Irish market through a broker like ourselves. All that is required from somebody to set up one of these savings plans under the Alpha Savings and Investment Club is that you just need to be prepared to save on a regular monthly basis from €100 per month, noting that that can be increased, decreased, stopped or restarted, or invest a lump sum of €5,000. You can do both, or you can do one or the other. There's no requirement to do both. You do need to be prepared to leave the money there for 5 years. So although you can access it at no penalties, as I mentioned earlier, I usually do recommend that people go into this plan with the notion of leaving the money there for at least 5 years, just so you're benefiting from compound interest and leaving markets kind of, you know, I suppose, work through any kind of short-term hurdles. And to sign up to our investment club mailing list, where we'll give you kind of ongoing updates on the funds and the performance of your plans. Zurich also have an online portal, so on any given day you can check up the value and the performance of your plan. And in Alpha Wealth, we are very much a relationship-based business. Okay, so we're about creating long-term relationships with our clients. I'm not in the business of setting up plans for people and saying good luck to you. It is about ongoing engagement and ongoing advice from us. So if anybody needs kind of, you know, ongoing updates from us, they can get it directly from Alpha Wealth as well. The final, I suppose, investment options that I just want to mention to people on this webinar, it's something called the Employment Investment Incentive Scheme. It's very, very different to the Zurich Easy Access Savings Plan, which I would just see as, you know, the all singing, all dancing alternative to sticking money into the bank, credit union or post office. Whereas the Employment Investment Incentive Scheme, it won't suit everyone. It's particularly for people who are top rate taxpayers. So that means single people that are earning anywhere, you know, north of €37,000 per year. So for anyone on the call who might be in that cohort and might have some money sitting on deposit and they want to get a really good return on that money and reduce their tax in the process, the Employment Investment Incentive Scheme, or EIIS for short, is something that I would, you know, urge you to consider. What it is a revenue-backed investment scheme whereby you can invest money in a whole host of qualifying Irish companies over a 4-year period, and anything that you contribute to the scheme, revenue will kick you back a rebate of 40% on your investment amount, and you also get a return from the company for the use of your money at the end of the 4 years. The tax relief is actually given in year 1, and there are some really, really solid companies that are raising capital under the scheme. We've been dealing with it for many years now, and there is 2 companies that we're currently raising funds for under the scheme. So if anybody wants to reach out to us following the webinar to get a bit more information on what they are and what that would look like, we're happy to help. But it is something that I would encourage people to, I suppose, consider and maybe kind of treat as kind of a shorter term pension, in that it provides the same tax relief. It's a really powerful scheme to do on a kind of an annual basis. In very simplistic terms, this is what a €10,000 investment in EIS this year would look like. So next year in 2023, usually kind of in the first half of the year, you get something called a statement of qualification from the company you invest with, which you can include as part of your tax return for 2022 this year. And revenue will then kick you back €4,000, which is 40% of your investment in this case, which makes the net cost of your investment just €6,000. In 2025, in year 4, all going well, you will get your initial 10,000 returns from the company, plus interest, which is generally in the region of about 30%. So you're getting 13,000 back in 4 years' time, all going well. So if you think about that, you made an investment which had a net cost of just €6,000 and you're being returned €13,000 in 4 years' time, all going well. So it's a double your money scheme if used right and if picking solid companies, which do exist. So in Alpha Wealth, we vet a number of companies every year, and we generally kind of cherry pick the top 2 to 3 most, I suppose, strongest companies to present to our clients as an option under the scheme. So that's really kind of the 2 kind of savings and investment options that I did want to speak to people about today, just to give you a feel for what is out there outside of your bank, credit union or post office, particularly over longer periods of time. Some of the other areas that we deal with in Alpha Wealth are things like mortgage advice, protection reviews, pension advice, and more specialist things like estate and succession planning. If anybody is on the call and they're kind of saying, look, the Zurich Easy Access Savings Plan looks great, but you know, the cost of living is quite high at the moment, I can't really afford to save on an ongoing basis, what I would suggest is let us review some of your main financial outgoings. And we generally save people quite a bit by reviewing things like their protection costs, their mortgage rate, and hopefully free up money, which will allow you to allocate to things like your pension and the Zurich Easy Access Savings Plan, and maybe EIS, to get a portion of your money working for you and help you to build wealth into the future rather than overpaying on things that you don't need to. We do arrange full financial planning consultations with clients who wish to avail of that service. And if anybody is following us on Instagram, you'll notice that we are running a competition at the moment whereby we are I suppose giving away 2 complimentary full financial planning consultations, which are worth €199 each before the end of May. So all you have to do is pop over to our Instagram and you'll see the details to enter that. If anybody does wish to discuss any of the things I mentioned on the webinar today, such as the Zurich Easy Access Savings Plan or the Employment Incentive Investment Scheme, we generally don't charge for discussing quite specific things like that, and there is no charge for kind of setting up that plan, and we're happy to talk to anyone about what that might look like for them. So as I mentioned, you can follow us on some of our kind of various social media channels to see some of the other webinars that we have coming up over the next couple of months. And I do just really want to thank everyone for taking the time to come on this evening. Look, I hope you found the webinar beneficial. My own contact details are on the screen there if anybody does want to reach out to me. And given that we have a bit of time there, look, I'm happy to open up the webinar to questions. So if anybody does want to unmute their mic and ask a question, you're more than welcome to.